Good morning. I'm reporting to you live from the Founded in FOCO Business Conference here in beautiful Fort Collins, Colorado. Let's go. First, let's check in with Graham.
Nobody ever gets rich when the interest rates are high because people can't borrow money.
Is that what you meant? The stock market going down was the disruption? What other disruption were you alluding to?
Look, you can't really watch the stock market. You have to do what's right.
What's up, you guys? It's Graham here. So I don't usually do this, but 2 weeks ago, I issued a warning to stock market investors. And unfortunately, since that video, things have gotten a lot worse. Just today, the market has seen its worst drop since 2022. Panic usually creates more panic, selling pressure creates more selling pressure, and prices are falling purely because prices are falling. So similar to my previous video, I'd like to help put into perspective exactly what's happening, why the market is crashing, how things could get worse before they get better, and what you could do about it to put yourself ahead financially. Yes, I'm probably going to have to repeat myself a few times, but at least you should understand the truth about what's actually going on. As soon as you hit the like button and subscribe if you haven't done that already, that's all I ask for. It helps the channel tremendously, and as a thank you for doing that, I will do my best to read and reply to as many comments as I can. So thanks so much, and also big thank you to Incogni for sponsoring this video, but more on that later. All right, now in terms of why the market's crashing, as of now we have the perfect storm, starting with tariffs. Now here's the thing when it comes to talking about tariffs. So far, here's how they've worked. Trump threatens tariffs by a certain date. The market goes down, but eventually starts to recover. On the day tariffs go into effect, the market plunges because no one expected it to actually go through. But 24 to 48 hours later, an agreement is reached that gives an extension. The market goes back up. And then the process repeats itself when tariffs go back into effect, waiting for another agreement to be reached. This volatility starts to give the impression that tariffs have simply been used as a negotiation tool to get more favorable trade deals within the United States, but the market never actually priced in the likelihood of them sticking around. Until this, it's currently scheduled that a 25% tariff on steel and aluminum imports are set to take effect March 12th, while a 250% tariff on Canadian dairy products could be next, along with a tremendously high tariff on Canadian lumber shortly afterwards. On top of that, what's really fueling the tariffs is that he said tariffs may still go up as time goes by. Now, even though that 250% dairy tariff has largely been debunked as an item that's not even going to begin going into effect, since they will be allowed a certain amount of dairy to enter the United States tariff-free, business owners are completely puzzled by what to expect, if they need to order inventory ahead of time, or if they have to start raising prices to cover overhead, to which Trump provided no additional information. To make matters worse, Canada retaliated by enacting 25% tariffs on electricity imports to New York, Minnesota, and Michigan starting right now, and China slapped back with 15% tariffs on American farm products. As a result of this, investors are beginning to price in the likelihood of higher prices, lower GDP, recessionary fears, and the potential that things could soon get much, much worse. But there's a second reason the market could be falling that most people have no idea about, and that would be Trump crashing the market on purpose. First of all, it's important to clarify that this is just a theory. But you know what? Nothing surprises me anymore. So here's what we know to be fact. Right now, it's no surprise, the government owes a lot of money. The national debt is currently sitting at over $36 trillion, and that number is only expected to keep going higher, which is soon going to cause a lot of problems. Why? Well, when you have a debt this large, you have to pay interest on the debt. And when interest rates are at record lows, paying off the debt is very easy. Like, imagine it to be like a mortgage. Taking out $1 million loan at 0.5% interest is as simple as spending $5,000 a year to keep current on your monthly payments. But what happens when interest rates go up during a time that you're borrowing a lot more money and you've only locked in that record low interest rate for a few years? Exactly. Since interest rates have gone up significantly, the United States is now spending more money on interest payments than they are on defense for the first time ever in history, which is massive. And in 2025, there's another $9.2 trillion worth of debt that needs to be refinanced. This means they either need to lock in rates when everything is high, Or they need to create a market crash, which causes interest rates to fall and gives them enough time to lock in interest rates for the next few years. Again, even though a lot of this is just a theory, some of it does make a lot of sense, because 70% of the $9.2 trillion debt needs to be refinanced by June 2025, and if nothing is done, that debt is scheduled to cost 1% more, which is reported to be $1.56 worth of cost for every $1 of revenue that the United States generates. Think about it. For Trump, this could be a huge win to refinance the national debt at a lower interest rate than usual by forcing the Federal Reserve to lower interest rates. Like, here are some quotes that I pulled from Anthony Pompliano, who's taken the time to compile some choice words by Donald Trump. Here you go.
I've been saying, let's get interest rates down. Nobody ever gets rich when the interest rates are high, because people can't borrow money. Interest rates are going down. You know what else is going down? Energy's going down. I'd love to see energy go down.
Is that what you meant? The stock market going down was the disruption? What other disruption were you alluding to?
Look, what I have to do is build a strong country. You can't really watch the stock market. If you look at China, they have a 100-year perspective. We have a quarter. We go by quarters.
That's true.
You can't go by that. You have to do what's right.
All of this paints the picture that maybe this is his way of reducing the cost of the national debt. Perhaps he could frame it as such a way that he's making asset prices like stocks, real estate, and Bitcoin more affordable to middle-class Americans by giving them a 10 to 30% discount. And if short-term pain is what's needed, then he's willing to get there by any means necessary. Although, in terms of how bad things could potentially get, you're going to want to take a seat. Although before we go into that, just like it's really important to protect your investments, most people so much, and now let's get back to the video. All right, now in terms of how bad things could potentially get, you're going to want to hear this. On a broad scale, there are 3 different types of declines that you're going to want to be made aware of. The first is what's known as a stock market correction that's defined as a drop of at least 10%. Now, it's important to recognize that normal volatility throughout the market is extremely common. Like, since 1920, the S&P 500 has, on average, seen a 5% pullback 3 times a year, so random fluctuations happen all the time. This is also somewhat the case with market corrections, which have happened on average every 16 months. In fact, if you're like me and you like averages, so far the average stock market correction has been 15.6% and lasts for 71.6 days. So it's perfectly normal, and every healthy market sees a regular pullback from time to time. However, after that we move on to the more serious category, and that would be a bear market, which is defined of at least a 20% drop from the peak. And this is where the NASDAQ might soon be approaching. According to the data, this typically hits every 7 to 10 years, and when it hits, unfortunately, it hits kind of hard. During a bear market, the stock market drops on average 33.2%, and it falls over a period of 363 days. Now, it is important to clarify that these are just averages, and it doesn't mean the next bear market's going to fall exactly 33% and last for exactly a year. For example, in 2020, we saw the fastest 30% drop in history since the Great Depression, and then right after that, we saw the quickest recession in history, which lasted just 33 days. So anything can happen. Although, in terms of taking it even further from here, things can always get a lot worse. And that's what brings us to a stock market collapse. I would consider this to be a drop of at least 40% throughout the entire market, and not just in one sector like cryptocurrency. And over the last 120 years, this has only ever happened 3 times. This is why a market collapse is rather uncommon, but it's not impossible to happen throughout our lifetimes, which is something that everyone needs to keep in mind. But in terms of what you could do to use this as an opportunity to come out ahead profitable, here's my take on things. First, when it comes to building wealth, it's important to recognize that there's always going to be a reason not to invest. Like, when I started buying real estate in 2011, the overall market had already fallen 50%, and I was buying some of these properties for 20 cents on the dollar. But I was told to wait because shadow inventory was about to be unleashed on the market and prices were about to fall even further. But guess what? That shadow inventory never came, the market recovered, and I'm so glad I didn't listen to all the people who told me not to buy. Even in early 2017, when I started making videos here on YouTube, there were so many headlines about how the market could be poised for a crash or how the market was overvalued. But I just kept dollar cost averaging on a regular basis, and I'm glad I did. The same thing applies to 2020, 2022, and I'm sure even today. Second, investing is not a game. I hate to say it, but when you really get down to it, investing shouldn't be fun. it should be pretty boring. I know that sounds weird to say because for me, investing is a total blast and I love it, but it's not a sign of a healthy market where people are trying to YOLO their life savings into whatever's the hottest stock of the day to try to get a brand new Cybertruck. At a certain point, you have to remember, if you're trying to beat the market average, you're either taking a calculated risk or you're gambling. And the line between the two has gotten incredibly blurred over these last few years. Third, overconfidence is going to destroy your portfolio. The moment that you think you have the entire market all figured out, you've lost. Because of that, it's really important to recognize that the less you know, the better you will do, because you're not going to overcomplicate things and take unnecessary risk for gains you never needed in the first place. For example, every single study shows that the best investors of all time simply buy into an index fund on a regular basis and hold it for 20 years. This is why dead people often make the best investors, because they don't touch it. They just buy and they hold. And that is what chances are you probably need to do as well. Fourth, let's face it, a market drop is probably going to be a lot worse than you expect. Like, you know when you see a decline, so you buy in, and then it drops even further, so you buy in even more, and then it keeps falling until eventually you run out of money and it keeps falling even more? Well, generally, market bottom takes place at absolute investor capitulation, where people think the economy is forever finished, no one is buying in, and people think to themselves that it'll just continue getting even worse. This was the case back in the worst of 2020, 2010, and I'm sure back in 2001, even though I was too young to remember that one. Every generation, I promise, is going to have their own moment when they think to themselves that this time is different, and even though it's always recovered in the past, this time, today, has never been like anything before, and we're probably all finished. That's why I tend to think that it's reasonable to expect that things can always get a lot worse than you expect them to, and just to be prepared for that. Fifth, good financial habits should be practiced in both good and bad markets. Even though now is certainly a great time to work some extra hours, take on a side hustle, cut back on unnecessary spending, and invest the difference, ideally, you should be doing that regardless of where the stock market trades. Yes, I understand it's not cool to live frugally and live below your means when everyone else is making 10x returns on meme coins, but I promise you, if you just stick with it long term, it's going to pay off 10 times more in the future. I guess I've just seen so many careers come and go, so many businesses go bankrupt out of nowhere, and so many investments lose value that I just tend to be overly cautious about what I do. Plus 6, it was found that in the event we hit a bear market, that half of the S&P 500's strongest days in the last 20 years occurred during a bear market, and another 34% of the market's best days took place in the first 2 months of a bull market before it was clear that a bull market had even begun. This is really important to mention because if you just miss the best days of the overall market, your returns drop substantially, and if you stay out of the market, it's even possible to begin losing money. This is why, regardless of what happens to the stock market or how bad the sell-off gets, there's always a reason to say, this time is different. Sure, the market might continue selling off much more than we initially expected, or it could rebound the next day. I have no idea. That's why, as long as I'm not planning to use this money over the next 20 to 30 years, any short-term fluctuations make no difference whatsoever. It's just an opportunity to buy in a little cheaper. And if you appreciate this message and me trying to get this video out as soon as possible, please hit the like button and subscribe if you haven't done that already. Again, that's all I ask for in return, and I'll do my best to read and reply to as many comments as I can. So thanks so much, and also, again, big thank you to Incognito for sponsoring this video. Their link is down below in the description, and until next time.
Because what we're doing is very big. We're bringing wealth back to America. That's a big thing.
Is a short squeeze coming? That's what we're going to discuss in today's video. Over the past few weeks, we've witnessed significant shifts in the stock market. Since February 19th, the S&P 500 has erased a staggering $5 trillion. Okay, that's trillion with a T, marking its most one-sided move since the 2022 bear market. Additionally, total put option volumes have surged to over 30 million contracts in just the last 5 days, which is a record high. So this raises an important question, and the whole point of this video is a short squeeze on the horizon. So let's break it down. So this chart right here is showing that record high that we just talked about. This is U.S. total put option volumes. This is a record. I can't state this enough. This is insane volume, you guys. So in just 14 days, the NASDAQ 100 has actually plummeted by 12.5%. And to put this into perspective, the S&P 500 was trading at all-time highs just less than 3 weeks ago. So such a rapid and one-sided decline is rarely sustainable over the long term, suggesting that this short trade might be getting overcrowded, and I'll show you why. So if you take a look at this, leading up to this decline, institutional positioning actually showed these shifts in these two red circles. So heading into 2025, hedge fund exposure to the Magnificent Seven, they fell to a 22-month low. So this created a significant divergence between the NASDAQ 100 fund positioning, and it's similar to these patterns observed before the 2022 drop, which we can see right here, okay? So we see this divergence right here. We see this pattern right here. Are these two going to cross again? And does this mean that we're going to see an upside in all this? So this recent data actually shows a change in sentiment, okay? So this is basically showing you net non-commercial futures positions of open interest. So this is basically saying that hedge funds have turned net positive on equities over the past week based on the S&P 500 futures position. You can see that where that red arrow is on the right-hand side of your screen. So this is the first such occurrence since the lead up to the post-election rally in November of 2024. But if we go to this next slide, you can see that it's also taken a bearish turn in sentiment. We're at extreme fear that was taken on March 11th at the time of this recording.
Extreme fear.
So this fear and greed index is now approaching levels similar to March of 2020. So historically, markets, they struggle to maintain extreme sentiment levels. So whether it's extreme fear or extreme greed, this is showing the importance of sentiment in driving market dynamics. And if you guys are looking for an insurance policy, if you are extremely fearful, check out today's sponsor, JM Bullion. Happy stacking. The interesting thing is, however, President Trump has actually expressed support for Tesla. We'll be talking about Tesla later in this video, stating that he plans to buy a brand new Tesla as a show of confidence and support for Elon Musk, aka the actual president. So this marks his first public endorsement of the market amid its current downturn. But if we keep going, he was asked by Maria from Fox News, President Trump actually refrained from making definitive predictions. So he acknowledged possible short-term challenges, but expressed long-term optimism. So his recent support for Tesla, which I just showed you, could actually signal a potential shift in market sentiment. Check out the clip right here.
You inherited a mess, and you said that the other night.
I've only been here.
But are you expecting a recession this year?
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time. But I think it should be great for us. I mean, I think it should be great. It's going to be great ultimately.
Okay, so you heard it there first. So the thing is, with crypto markets, they're often seen as sentiment indicators, okay? We can take a look at this chart right here, but they're mirroring this volatility, okay? So last year, crypto markets experienced extreme greed, but now they've swung into extreme fear. Today, both tech stocks and cryptocurrencies are showing signs of recovery, which I can show you on this next slide right here. You can see that, these things are basically up. This is basically up. You got Bitcoin rebounding over 80,000. It was at 109, just a few months ago, but it is what it is. So if we take a look at major tech stocks, they actually constitute over a third of the S&P 500. They've entered deep bear market territories, if you look at this chart on the screen right now. So Tesla's dropped 50%. I remember when it was just trading, above 350 easily just over the past couple of weeks. Now you can see where it is at the time of this recording. And then also a relief rally in these magnificent stocks could potentially drive a significant rebound in the S&P 500. So that's what we're trying to get at with this potential short squeeze. Is it coming? I have no idea. But we can see that the market cap of the Magnificent Seven as a share of the index total, again, is 1/3, its highest ever. And you can see that long Magnificent Seven was the most crowded trade based on the Bank of America Global Fund Manager survey. It's 71%. That was dark blue of July 2024. Light blue is June of 24. And then gray was May of 24. So super overheated. So in summary, the market currently reflects this. We have global tariffs and recession fears. Hopefully those are being priced in. Extreme fear in both stock and crypto markets. We have polarized short positioning, okay? Major tech stocks are deeply discounted, and then potential shifts in political sentiment. So once we combine all this stuff together, I mean, hopefully it's a market reversal, right? It seems like it'll be imminent, but as always, it's crucial to remain vigilant, informed, and prepared for potential shifts in the financial landscape. So with all that being said, my thoughts are basically, is everything getting cooked right now? Absolutely. If you looked at my last couple of videos, I have that crying Jordan face saying, live look at my portfolio. It's what it looks like. But at the end of the day, if you dollar cost average and you're in it for the long term, this shouldn't be shaking you. If you're getting shaken out right now, that means you're either too much skin in the game or too much of your net worth is in whatever is getting shaken out. And obviously this video is about equities, some about crypto as well. But at the end of the day, again, sleep well at night. You should only have these asset classes as a percentage of your pie. So again, if you have 99.9% of your wealth in, Tesla, then yeah, you're crapping yourself right now. If you're in broad diversified index funds, you're still kind of crapping yourself, but not as much as the single shareholder of Tesla, right? So just remain diversified. That's how I invest. And then also don't have your pie slices any bigger than what would prevent you from sleeping well at night, if that makes sense. So hopefully you got value out of this video. Please share it with a friend, comment, hit the bell notification. And as always, have a prosperous day.
All right, this time, let's check in with Mr. Tilbury.
The stock market is over and you should get out before Trump triggers a full-blown recession. That's what the mainstream media want you to think. Headlines are screaming disaster, social media is in a frenzy, and everyone is asking the same question. Should I sell now before it gets worse? But there's more to this than meets the eye. If you followed me for a while, you know I'm a serious investor who's obsessed with the stock market. And since so many of you have started investing because of my videos, I feel a responsibility to give you my honest take on the situation. So before you panic, let's take a step back and look at the bigger picture together. Every market crash has a cause, and this one isn't random. There are three main triggers behind it, and all of them tie back to one man, Donald Trump. Now, before anyone jumps to conclusions, this isn't about politics. I'm not here to take sides, and as a British investor looking in, my only concern is how this impacts investors like you and me. So let's break down the three biggest triggers behind this crash, why they matter, and what you can do to benefit from all this mayhem. Trigger one is Trump's trade war. Trump has always pitched himself as the ultimate deal maker. He's the guy who fights for American jobs and plays hardball with other countries. But the trade wars he's fighting could increase your weekly shopping bill and cause a recession. The last time the US tried this, it helped trigger the Great Depression, wiping out jobs and wrecking the economy. Now, history might be repeating itself. Stocks are already crashing, prices are rising, and if this spirals, it won't just hurt Wall Street, it'll hit you where it matters most, your bank account. Let me take you back to 1930, when I was just a boy. The US government decided to slap massive taxes called tariffs on imported goods to protect American businesses from foreign competition. It was called the Smoot-Hawley Tariff Act, and it turned out to be one of the worst economic mistakes in history. At first, it seemed like it would help. American companies wouldn't have to compete with cheap imports and more products would be made in the USA. But there was a big problem. Other countries fought back. Nations that used to trade with the US started raising their own tariffs, making it harder for American businesses to sell products overseas. Trade slowed to an absolute crawl. Businesses collapsed and millions lost their jobs. Instead of fixing the economy, it helped turn a regular recession into the Great Depression, one of the worst financial crises ever. Fast forward nearly a century, and Trump has brought back tariffs in a big way. In February 2025, Trump announced a 10% tariff on Canadian energy imports and a 25% tariff on other Canadian goods. In retaliation, Canada imposed a 25% tariff on American imports. Then in March, Ontario implemented a 25% surcharge on electricity exports to the US, affecting states like New York, Michigan and Minnesota. However, in my opinion, this was more of a symbolic move that wouldn't have seriously damaged the US economy. However, Trump didn't hold back, and instead of just brushing it off, he fired back by increasing tariffs on Canadian steel and aluminium to 50%. Unlike Canada's move, this wasn't just for show. It hit Canada's manufacturing industry hard while also driving up steel prices for American businesses that rely on imports. But why am I telling you all this? Well, this is where the real problem starts. Tariffs sound good on paper, as they're meant to punish foreign businesses while encouraging more stuff to be made in America. But in reality, they end up hurting regular people more than anyone else. As a business owner who manufactures products and imports from China myself, I know that when businesses are forced to pay more for materials, they don't just absorb the cost, they pass it on to their customers. That means higher prices on cars, appliances and electronics. In addition to this, food becomes more expensive because supply chains get disrupted, meaning that everyday essentials cost more, stretching household budgets even further. On top of that, other countries aren't just sitting around while Trump raises tariffs, they're forming new alliances to trade without the US. China is leading the charge with the BRICS alliance, partnering with Brazil, Russia, India and South Africa to reduce dependence on American trade. So the more the US isolates itself, the more other countries look elsewhere for business. So what's my opinion on all of this as an experienced investor? Well, if Trump goes all in on this trade war, history suggests it'll do more harm than good. While some industries might get a short-term boost, the long-term damage, such as higher prices, weaker global ties, and a slowing US economy, could far outweigh any benefits. But if I'm being completely honest, I don't think Trump actually wants high tariffs. I know that sounds crazy, but hear me out. Trump is, at his core, a businessman and a deal maker, just like me. That's why I believe he's using tariffs as a negotiation tactic, not as an end goal. So if that's true, what does he actually want? Well, I think he's after free global trade, but on terms that favour the US, and if he pulls that off, it could pay off big time. However, the problem is his approach is creating massive uncertainty. The constant backtracking, new tariffs and mixed signals are spooking the stock market because investors hate unpredictability. If this drags on too long, it could shake confidence so much that it pushes the economy towards recession, something even Trump's own administration has admitted they're willing to risk. Right now, the market isn't just reacting to tariffs. It's reacting to uncertainty about what comes next. And in investing, uncertainty is one of the biggest killers of confidence. Trigger 2 is Trump's stance on NATO. Trump has openly questioned the role of NATO, the military alliance that protects Western countries. He suggested that the US shouldn't keep defending allies unless they start paying more for their own protection. While that might sound like a fair demand, if the US steps back from its NATO commitments, it could create a power vacuum that countries like Russia and China might exploit. Markets hate uncertainty. The second investors sense that world stability is at risk, they panic. If NATO weakens, it could encourage Russia to push further into Europe, or even lead to new conflicts as countries try to adjust to a world without the USA acting as the global police force. More conflicts mean higher military spending, unpredictable trade relationships and spikes in energy prices, all of which can rattle the stock market. Trigger 3 is Trump's secret plan. There's been a theory circulating that Trump may be crashing the stock market on purpose. I know that sounds crazy, but there is some evidence for it. Trump has never been a fan of high interest rates. In fact, he's called them ridiculous and has openly attacked the Federal Reserve for keeping them high. Now, here's where it gets interesting. The Fed is technically independent, meaning Trump can't just tell them to cut interest rates, but their decisions are based on economic conditions. If the stock market crashes and a recession seems inevitable, the Fed has no choice but to step in and slash interest rates to prevent a total meltdown. But why does Trump want lower rates? Well, because high interest rates slow down the economy. Businesses borrow less, stocks struggle, people stop spending as much, and for Trump, who loves growth and hates anything that makes America look weak, they're a problem. It's not just about making the stock market go up, it's way bigger than that. The US government is drowning in $36.5 trillion of debt, and when interest rates are high, the cost of that debt goes through the roof. Think of it like a massive credit card bill. Imagine you owe $36,500 and your credit card company charges 10% interest per year. That means before you even start paying down the actual debt, you're being charged $3,650 every single year just in interest. Now imagine the credit card company suddenly slashes the interest rate to 3%. Instead of paying $3,650 per year, your interest drops to just $1,095 annually. That's a saving of $2,555 every single year. Now you can put this money towards actually paying off your debt instead of just keeping up with your interest payments. Well, that's exactly what Trump might be doing, but on a $36.5 trillion scale. If the Fed lowers interest rates, the government can refinance its debt at a cheaper rate, saving billions, if not trillions, in interest payments. This wouldn't be the first time something like this has happened. If Trump can create that opportunity on purpose, it could go down as one of the smartest economic power moves in history. If this theory is true, we're not looking at a long-term economic collapse. We're looking at a temporary shake-up before a massive rebound. So you're probably wondering, how can you benefit from this crash? Well,
yes,
you need to understand that stock market crashes aren't rare disasters. They're a normal part of investing. Every few years, the stock market takes a hit. People panic and headlines scream, the end is near. But history tells us a different story. Every crash of the US market has been followed by a recovery. The people who panic and sell usually lose money, while the ones who stay calm and invest strategically often come out on top. Instead of freaking out, this is the time to prepare, make smart moves and hopefully set yourself up for massive gains when the market bounces back. Look, I'm not a financial advisor. However, I have made millions during stock market crashes. So here are my thoughts on what you can do to prepare. Step one is to invest while the market is down. Before you even think about investing, you need a rock-solid financial foundation. I know I've said it before, but it's worth repeating. That means building an emergency fund of at least 3 to 6 months' worth of living expenses and eliminating any debt with an interest rate above 8%. Assuming you've done that, if you've never invested before, this could be one of the best times to start. Stocks are essentially on sale. During the 2008 financial crisis, I was still investing at the bottom and saw my investments double within a few years. However, many of my friends panicked and sold, locking in their losses and missing out on the recovery. No one can perfectly predict the exact bottom of the market. But if you invest consistently while prices are low, you'll be buying assets at a discount. If you want to get started, then Trading212 are currently giving you a free fractional share worth up to £100 when you use the code Tilbury in the app and fund your account. If you've been waiting for a good time to do this, then this could be it. I'll leave a link in the description below if you're interested. Step 2 is to stay disciplined and think long term. Market crashes aren't random, they follow predictable cycles. There are 3 types of crashes. Corrections, which is a 10 to 20% drop. These happen frequently and are part of a healthy market. Bear markets, which is a 20 to 40% drop. These happen every few years and last about 289 days on average. And full collapses, which are more than 40% drops. These are rare, but have historically been followed by huge recoveries in the USA. The biggest mistake new investors make is letting emotions dictate their decisions. When stocks drop, fear kicks in and people sell at a loss. When stocks rise, greed takes over, and then they buy at inflated prices. This cycle is why most people fail at investing. So if you're already investing, the worst mistake you can make is panic selling. Selling while the market is down locks in your losses and keeps you from benefiting from when stocks recover. Instead, consider increasing your investments while stocks are cheap. Stick to a long-term strategy like dollar cost averaging. Invest in a fixed amount every month, no matter what the market's doing. This reduces the risk of buying in at the wrong time and ensures you're steadily building wealth. Remember, the best investors see downturns as a chance to buy more. Step 3 is to diversify your investments. Putting all your money into one type of investment is a recipe for disaster. The key to surviving market crashes is diversification. This means spreading your money across different types of assets. My portfolio includes stocks, bonds, precious metals like gold, real estate, and even cryptocurrency. It's also worth considering dividend-paying stocks, as they actually perform well during downturns because they generate passive income even when prices are low. Just remember, market crashes aren't the end of the world. If you understand how to navigate them, you won't be the one panicking. You'll be the one taking advantage of the opportunities while everyone else is running for the exit. This isn't the time to fear the market. It's the time to prepare, invest wisely, and stay patient. The ones who make the smartest moves now will be the ones who come out on top when the market rebounds. If you want to know how to invest in 2025, then I'm going to leave that video right up there. But don't click on it just yet. Make sure to subscribe if you want to grow your wealth, okay? I'll see you over there.
You should always like and subscribe. Moving straight over to Yahoo Finance right now.
Well, the Magnificent Seven is in the red this year. Meta, Apple, and Tesla, the worst performing of the bunch so far, with Tesla off 46% from its prior high. Meta and Apple both down 18% from their highs as well. So what's next for the tech trade? Joining me, Brian Belsky. He's the Chief Investment Strategist over at BMO Capital Markets. Brian, great to have you on here. I just want to get your take specifically on the Mag 7 here. Can investors still trust in the tech trade?
Oh, good morning, Yahoo. Good morning, Madison. Yes, the answer is yes. Just because stocks go down doesn't mean that they're bad assets or bad companies. Remember, 2022 was a very tough year for tech, given what happened in 2021. God giveth and God taketh away. And then we had this huge rebound in 23. 24 was about the AI trade. And maybe these tech stocks got ahead of their skis a little bit. But at the end of the day, these are monster companies that define the growth trajectory for the United States stock market. They are not going away. We believe that, as we have for over 10 years, these large cap technology stocks, some of which you listed, by the way, some of those in the Mag 7 are actually consumer discretionary and communication services stocks, technically. We believe these now are the new consumer staples, quote unquote. Doesn't mean that you need to overweight those names. That's actually not our call. Our call is to overweight technology in general and to create a barbell. What's the barbell? You are equal weight or slightly underweight select names within the Mag 7, and you are overweight other areas in technology. That's called portfolio management tracking error, and that's how we think we're going to get risk-adjusted returns from here.
So what would you say is the single name in the Mag 7 that is the most viable dip right now?
Apple. Apple's the best company in the world. It's got more cash than several countries out there. I think this notion of the Siri not being ready in terms of new AI, people are just using excuses to sell the company. This is a company that you buy on dips historically. It works until it doesn't work. But at the end of the day, this is still a company that defines innovation and great management and great products for the United States. So I would put Apple as the #1 buy on the list in terms of trying to buy the dip.
There you go.
And are there any repositioning moves that you are making off the back of this? I know that you hold all members of the Mag 7 except for Meta. At what point is the discount for Meta too good for you to ignore?
Listen, if we look at Meta and we look at how it trades from a fundamental and price performance perspective relative to Google, we're putting our money into Google. You don't have to own everything, Madison, by the way. Meta is a name that we would look at maybe if we see additional downside. But we've only recently, in terms of October, bought Tesla, and we have a very small position. We'd actually love to be able to buy more of that. We typically make changes at the end of the month. So we're investors. We look at positions and performance on our portfolios that we run for our great wealth management channel. We run just over $10 billion. And we typically make changes at the end of the month to kind of dissuade from big amounts of turnover. But we think the reaction in Tesla is massively emotional. We're letting feelings versus facts, and we do believe that this is a great buying opportunity longer term for a company that is just an amazing technology company.
Brian, I'm fascinated. Let's talk about Tesla for a second, because I've been fascinated by this story here. And just the degree and speed of the sentiment shift on Tesla feels like something I personally haven't seen. You've obviously been doing this longer than I have. I did a TikTok about this week. I have 170 comments from people who have said that they have turned bearish on Tesla. At what point does the fact that consumers don't want to be inside of a Tesla start to weigh on the company?
I think, again, everybody needs to slow down in terms of their emotions on Tesla. This has been a couple of months. Let's just take a deep, deep breath. This is a company that's been in the works for decades, that it continues to exude technology prowess with one of the smartest, most brilliant people in the world. Whether or not whatever your political connotations is, again, you need to set politics on the side and take a look at what that man has done with respect to his companies and his technology going forward. We do believe that Tesla remains the best EV out there. We do continue to believe that its technology is the best with respect to Tesla robotics or driverless cars, and or what he's done for Starlink and SpaceX. So I think this notion of consumers not saying they're going to be in a Tesla anymore, or some of the actions and issues that they're displaying, I think is quite frankly deplorable. And obviously, I obviously don't agree with that type of behavior. But at the end of the day, this is a great company, and we do believe that it will be around for the next 5, 10, 20 years.
And I know you mentioned in your note that selectivity is critical when it comes to the tech trade. What are some of the names that you are looking at outside of those big tech names we talk about all the time where you see opportunity?
Well, we have the very good fortune of running what we like to call 8 separately managed accounts and 1 ETF and 1 mutual fund for BMO Wealth Management. And Oracle's a name that we've owned in our value portfolio for several years because it was a cash juggernaut. And then it quickly turned into a great AI name because of that cash and because of the R&D that it did with respect to surrounding AI. So Oracle would be our largest overweight outside of the Mag 7. Now, it's still a pretty big company, but it's nowhere near what we've seen in that. We also own a company called Broadcom in our dividend growth portfolio that has been an amazing company longer term. Qualcomm we own a little bit of, and we are bottom fishing in AMD because we do think that AMD is to NVIDIA what Coke is to Pepsi. And we do believe that's a name that can do very well and actually has been unjustly beaten up here over the last 6 months.
And I want to end kind of where we started, Brian, on how the sell-off in tech is making you think differently, perhaps, about where the market is heading. Does the tech sell-off alone tell you that we are heading toward a bear market?
No. In fact, any second now, we're publishing a piece in the public domain talking about this correction. And I think that so many of my compatriots, colleagues, competitors are basing their opinions on what they don't know. And it's really, we're in uncertain times. And the uncertainty we all know is all about that T word. I'm not going to mention it because everybody talks too much about it. But what do we know? We know 3 things. Number one, as you said in the top of the broadcast, that the S&P 500 did finally academically enter into a 10% correction. We wrote about the anatomy of a correction that typically and historically since 1950, these types of corrections that happen this fast go right back up and recover just as fast, if not more. Thus, we remained very comfortable with our $6,700 and $275 targets in terms of price and earnings, respectively, for the S&P 500. That's number one. Number two, in terms of fundamentals, they're still flashing green, not yellow, not red. Everyone's starting to talk about a growth scare based on no absolute data that's showing that. And we have some cool charts that show earnings growth in the report. Lastly, we're not an economist, nor do we play one on TV.
I like cool
but
charts.
The major economic data that we look at are not showing disintegration. On the consumer sentiment side of things, you mentioned November 2022. You know that was within 2 weeks. That was 2 weeks after the market bottom in October of 2022. That was the start of the new bull market, started in October of 2022. That was the bottom. So consumer sentiment, macro data is typically lagged. We would say be very, very cautious with respect to those types of things. And as long as everyone has become so bearish, we've actually become more and more bullish. So we feel very, very good to be a fundamental investor right here, right now.
Wow. Did you get all that? So do me a favor. Like and subscribe. As you can see, I'm just kind of getting started here. I can use your help.